Right, welcome back. If indeed welcome back is the right thing to say, because Paul and I did have a little chat on inflation, which will be on site for you to look at, and we thought we would follow up by having a little chat about interest rates, particularly as it was minimum lending rate or bank rate now, whether indeed the Bank of England should act in the way that it does act with regard to interest rates. Now, Paul's a relative youngster, so he won't remember this, but back in the 1980s there was quite a big discussion about whether or not you should control the monetary policy through controlling price, controlling interest rates, or whether you should control it through quantity, the physical quantity of money in the economy rather than its price. In other words, leave interest rates alone and just manage the quantity of money. And I was very much in favour of not managing interest rates at all, of managing the quantity of money. But if you manage the quantity of money, that does impose a considerable discipline upon governments and their fiscal policy, because you can't put yourself into a situation where you have a large borrowing requirement and a lot of that borrowing requirement is left unsold at the Bank of England and money gets printed against it if it goes outside your quantity controls. Price is much easier because, to an extent, if governments, they did overspend their budget and there was debt unsold at the Bank of England and money printed and the monetary base grew, you could claw some of that back by pushing interest rates up and discouraging lending. So there was much more scope, if you like, for governments to be a little more flexible in the way that they act if you used interest rates or price controls rather than quantity controls. So I lost that debate, and we ended up in a situation where really since that date right up to now, interest rates are almost seen. I say almost because other things have crept in recently, as we will no doubt discuss a little bit later on. But interest rates have been seen as almost the only tool that the Bank of England has to manage the level of monetary demand in the economy. So the question I would like to ask Paul is, does he think that controlling bank rate, interest rates, is the best way to pursue monetary policy, or would he think that quantity of money controls are a better way of managing monetary policy?
Well, of course, the answer is neither work terribly well, and I don't think that's necessarily the right way to think about it. I mean, I do remember the 80s, and there was extensive debate about how to set the quantity of money, and in the end people gave up because, first of all, they couldn't control the supply of money, and when they did manage to control the supply of money, it didn't control the economy in the way they expected because of changes in philosophy. Now, in theory, the quantity of money and the relevant interest rate would be directly linked, and in a world with no surprises, no uncertainty, it would just be a mapping between one or the other, and it wouldn't matter even. But the fact that the quantity of money was difficult to control and didn't really have the effect on the economy that we wanted is also symptomatic of interest rates. I've spent much of my life trying to estimate relationships between the real economy and interest rates, and it's almost impossible to find a significant effect from interest rates on the economy. So what I would say, however, is this. If you have high inflation, and for me anything above 5% inflation is high, we know that if you put interest rates up enough, you will slow down the economy, slow down money growth at the same time, and you can get inflation back under control. But the cost of doing that is quite high in terms of the downturn in output that you will get as a result. And I don't think that matters. You could say exactly the same for reducing the supply of money. If you do it through reducing the supply of money, you'll get more volatility in interest rates and probably a bit less precise control. Similarly, we know if you get enough deflation and you print enough money, then you should be able to get inflation back up again. It's a bit harder trying to get inflation up through cutting interest rates because it's very difficult to set interest rates below zero. And so we have actually seen in the last 10 years the reverse of the arguments before, where people have tried to get inflation up by printing money without a great deal of control or success, although inflation did eventually come back to something like 2, at least in the Western countries, if not in Japan. So I think what actually happens most of the time is we threaten to put interest rates up or down, or we actually move interest rates up and down, but we don't do that with the idea that this is going to have a direct impact on the economy very much. We do it to convince people that inflation is going to go up and down. As we discussed in our previous discussion on inflation, you're actually trying to control people's expectations. You tell people inflation is going to be 2%. When it threatens to get above, you tighten policy, whether that's reducing money supply or increasing interest rates. When it threatens to go below 2%, you do the reverse, and you try and convince people you're going to bring inflation back to 2. And if you've got credibility, it will work.
Yes, I'm concede the point, obviously, that the changes in the quantity of money will have some impact upon interest rates. If the money supply expands quickly, it's likely that interest rates will fall. If there's a contraction or a slowing down in the quantity of money, it's likely that interest rates will rise. There is a definite relationship between quantity and price. But that relationship can also be separated, and I often sort of see a situation where I think that the setting of an official bank rate is unrelated to what the market rate of interest would be. A market rate of interest determined by a quantity of money will go up and down, but a market rate of interest determined by a central bank as part of its official policy can sort of separate from what I would consider to be the market rate as quantity changes. And for that reason, I would just like to leave a market rate of interest out there. The Bank of England has to respond to a market rate of interest in the way that it acts, and that its concern should be looking at the quantity of money. And we did, again, think along Friedman lines of having a target for the quantity of money, and we had a target for M3, which we hoped to achieve. And I think that's where Goodhart's law came from, wasn't it? That as soon as you do create a target for something, then you've determined that it won't ever be achieved. And it did happen that it wasn't achieved. Now, I think it wasn't achieved for something that was totally different from changes in the quantity of money. In fact, the quantity of money wasn't changing at a time that it looked as though it was changing a lot, because at the same time you were converting building societies into banks. And building societies' deposits were not part of Sterling M3, but bank deposits were part of Sterling M3. So just by moving a building society into a bank, you saw, even though there was no change in the amount of money in the economy, an increase in the measure. And I think that put a lot of economists off and said, no, there's no need to deal with this. You can't, once you set a target, you're never going to achieve it because other things happen. And it was almost as if they gave up, in my mind, and went, yeah, interest rates, it's much easier. We can say a number and we can discourage or encourage people to act. If we get that number down a little bit, we'll encourage people to borrow. And we've seen in the economy that there's a little bit of flexibility, there's an output gap, there's some unemployment. So if we push interest rates down a little bit, people will borrow and the economy will expand. And then if we see inflation going up to, Paul's magic number of 5%, but getting close to 5%, then we would act differently. We will try and push interest rates up to discourage any further inflation taking place.
Yeah, it's interesting, John. I'd like to throw one slightly different curveball into the mix.
Yep.
The problem we have is that in modern economies, particularly those with open borders, when you have an increase in monetary demand, it doesn't have to go into domestic output or domestic inflation. And what we have seen in periods under the inflation targeting regime is that it tends to come out in the current account balance. And what we had in the early 2000s in the UK was we did have excess money growth. We had broad money growing in double digits most of the time, but inflation was relatively low and stable. We didn't seem to have a very fast growth in output all the time, although the figures have since been revised up. The problem is it can go into the external account and you just import more. And when you have no trade barriers, you can import more for a very long time. Both the UK and the US had very much advancing current account deficits. And everybody was saying, this isn't sustainable. And it wasn't sustainable, but you can run for years in that sort of position. So you can get suppressed inflation coming through the current account, and that's one of the issues. It's affecting us now because with supply restrictions caused by Brexit, it's much harder for the excess monetary demand to go into imports. And we're seeing those sorts of restrictions on trade helping to drive up domestic prices. And so I think we do have to take into account the nature of the economy, whether it's how open and closed it is, whether or not, how flexible international trade is in the circumstances one is talking about. But actually the solution to that, you find, is you can't control both domestic inflation and the external position with one instrument, whether it's interest rates or monetary supply. They're essentially the opposite sides of the same coin. You need other instruments. In particular, you need to think about control of fiscal policy in order to control both domestic inflation and the external account.
I certainly agree with Paul in his description of what an expansionary monetary policy might do to the external account, and indeed we have managed to sustain rather large deficits on the current account for rather a long time as the result of a leakage, if you like, from domestic policy into imports. And that often does have an impact on the exchange rate, and the exchange rate falling will often have an effect on the rate of inflation. We sometimes mistakenly say that we are importing inflation, which we're not, of course, doing. The inflation was caused, the imports rising in price is just a symptom of that previous monetary expansion. But I think Paul and I will probably talk about this in more detail in another chat, and I'd like to bring us right back to interest rates, because Paul was worried about interest rates or bank rate when inflation goes over 5% and needs interest rates to rise. I wonder, I'll let Paul talk first before I say much about this, but I think that the current bank rate policy of having interest rates artificially low, I would say, at 0.1%, is not the best way to manage the current situation. I would have interest rates much higher than that. A rough rule of thumb might be several percentage points above the rate of inflation, so I might even have them up at 6% now for bank rate or something like that. But I wonder what Paul's take is on this. Do you think, Paul, that 0.1% bank rate is currently the rate we should have in the economy?
No, I'm not sure it's the rate we ever should have had, really. And I rather regret that we cut interest rates so low back in 2009. As it then was. My first week on the MPC, we cut interest rates to 0.5% and announced the start of QE, and my feet didn't touch the ground for 9 months after that. But the problem we have is this: even theoretically, the impact of interest rates on the economy is uncertain. Both it's theoretically uncertain as well as empirically uncertain. It's based on the Keynesian idea that when you cut interest rates, you take money from savers and give it to borrowers, and you also increase the incentive for people to spend rather than to save. But quantifying that is very, very difficult, and the effects always seem quite weak. And most of the quantification that has been done was around changes in interest rates which are much higher. We were talking about having 5% interest rates or 6% and changing interest rates by half or 1. We've actually got very, very little evidence of what happens when you cut interest rates from, say, 1 to 0.5%. The one thing we can be sure of, it's not a linear effect, because if you change interest rates from 6% to 5%, you'll have one impact on savers. If you cut interest rates from 1% to 0%, the percentage impact on the income that savers get is much, much bigger. And there's reason to believe that as you get closer to zero interest rates, the balance between savers and borrowers shifts, and that you would get less stimulation from a change in interest rates. But the truth is, we just don't know. The evidence is not there. the theory hasn't really, in my view, been properly worked out. We do know that in general, if you put interest rates up enough, you can bring down inflation. I think the jury is out on whether you can cut interest rates enough to stimulate inflation when it's below target. And I actually think when we do manage to put interest rates back up, depending on the precise circumstances, in the first instance, that might actually increase monetary demand. The economy would work better with higher interest rates. It actually would be stimulative. Until we get interest rates up, I would suggest closer to the rate of inflation, actually above the rate of inflation. John's right, you would normally expect the level of nominal interest rates to be up around the level of nominal demand growth in the economy, which might be 4 or 5%. Now, there are various reasons why the long-term rate of interest may be lower, but you still expect it to be higher than the inflation rate. Certainly higher than the expected inflation rate on the true definition of real interest rates. So I think we might well agree that having interest rates this low for this long is a bit scary. Regardless of what it's doing to monetary growth, I'm not sure it's stimulating the economy, and I think the evidence of it having stimulated the economy over the last 10 years or so is very weak, especially in those countries which went as far as having negative interest rates.
Thank you. That's good. I've got Paul leaning a little bit my way. I didn't expect that. I thought he was going to jump straight in and say 0.1% was the right rate and wonderful. So let me push him a little bit further on this one, of course, because the textbooks say, and I always teach, that there is an inverse relationship between interest rates and asset prices. And one thing that has worried me during the whole of this period of sustained low interest rates is that asset prices are sustained at a higher level than they would otherwise be if things returned to sort of market conditions. So I see bubbles in asset prices. I see bubbles in house prices. I see bubbles in stock markets. I see bubbles in commodity prices. I see a lot of bubbles in the economy which are there, I think, because at the secured end of the lending rate, interest rates are so low. That produces the difficulty of how do you get out of this without reverting to lower prices for assets, which means lower house prices and lower stock market prices. And I think this is a worry for many central banks, and certainly a worry for central banks around the world, with the added difficulty of if one central bank acts upon its own to push interest rates up, it has one additional problem, which is volatile exchange rates. It creates volatility in their exchange rate. I have always argued, in fact I was at a Bank of England discussion once with Mark Carney and Mario Draghi, where I did try and encourage people to think about central banks getting together and raising rates of interest at the same time to avoid volatility and to do what Paul was saying, to try and bring back better market conditions, if you like, for prices in financial markets. And I do think, as Paul hinted, that growth rates will be higher with higher interest rates, not lower, as is, again, another textbook explanation. I don't know whether you've got any thoughts on that one, Paul?
Well, the asset price aspect is interesting. We know there's a mathematical inverse relationship between bond prices and interest rates. That's just what I was leaving that on one side. Of course, but cutting interest rates to close to zero and increasing the stock of asset purchases, which the authorities did, that was intended to raise asset prices. One of the channels through which monetary policy does work is through increasing wealth, and increasing asset prices is one way of trying to generate that. So it was intentional, let's be clear about that. Difficult to control what the exact outcome is. Now, whether there are bubbles or not is a good question. The real problem with bubbles is you don't know you've got one until they burst, for sure. I would say I'm not sure there's a bubble in house prices. The problem with house prices is that many more people want a house than there are houses available, and it's in that situation it's inevitable that house prices will go up sharply relative to all other prices, and that's what we're seeing. And it's very difficult then to know how much of the house price increase is relative and how much of it is a sign of there being excess monetary demand. But there will be excess money demand for houses because the supply is so sticky. So that's a bit sure. It's less clear to me whether there are bubbles in, say, stock market prices. To me, it does look as if stock market prices are a bit higher, but they've looked that way for 10 years, and nothing has happened in consequence yet. So
as have interest rates been that low for 10 years, haven't they? So that could be a self-explanation there. But one thing about property prices that, of course, is interesting, because you talk about the demand for property prices is in excess of the supply, and it's certainly in excess of the supply if you look at the mortgage rate. People are buying properties, taking out mortgages for less than 1%, admittedly only for a fixed term, but of course you can keep refixing these terms. It will be interesting over the last 10 years, all the refixing that has taken place, how low the rate has been kept during that period of time. But I mean, I remember interest rates, therefore mortgage rates, being above 10%. Imagine now what impact that would have on the housing market if there was a change from a mortgage of less than 1% to a mortgage where you were paying more than 10%. That would have significant impacts upon house prices, and that is what I think the bubble is. The bubble is there because interest rates and the mortgage rates are so low. Which takes me just to one final question, Paul, and that's about the structure of interest rates, because I think there is a feeling quite often that the Bank of England is dealing with interest rates as in all interest rates. In other words, the transmission mechanism is that the bank rate goes down, all interest rates go down, bank rate goes up, all interest rates go up. But Paul and I would know that if you look around the economy now, you will find you could borrow to buy a property at less than 1%. But if you want a payday loan, you'll probably be looking at 2,000% is your charge. If you want to borrow at the unsecured end of the market, then interest rates are very high. In fact, one of my students looked into credit card rates over the last 15 years, and they found now that credit card borrowing, unsecured borrowing, is 3% higher than it was before the global financial crisis. So in one sense, interest rates go down at the secured end, but they may not go down at the unsecured end and may indeed go up. Now, what worries me there is that central banks are therefore distorting interest rates, bringing this distortion in at the bottom secured end of the market, which I would relate back to the bubbles that there are in the economy. And it would be better, in my mind, if that distortion at the bottom end was removed by interest rates being higher than they are now, and significantly higher than they are now. So any thoughts on the structure of interest rates?
Yeah, it is an interesting one. Most central banks target a very short-term rate. So in the case of the UK, we pay bank rate on the deposits that commercial banks have at the Bank of England, and the Bank of England's effective target rate is the risk-free rate, or secured rate if you want, between now and the time of the next MPC meeting. So it's a very short-term rate. The only central bank that really differs from that is the Swiss National Bank, which has targets 3-month interest rate in the market. So it's slightly different, but it's still very short-term. Now, in fact, of course, there's a whole variety of interest rates out there, and essentially there are premia depending on who the borrower is and how long you want the transaction for. So if you're bad credit risk, you'll have a credit risk premium, that's the unsecured rate. If you want to borrow money for a long time, you'll pay a term premium. And so the yield curve, the interest rate for, say, 1 year relative to 3 months, or 5 year relative to 1 year, that yield curve will usually slope upwards. Very unusually in the UK, it tends to slope down over about 25 to 40 years, but that's because of pension funds and life insurance companies needing very long dated interest rates, and there not being enough assets. So let's leave that on the side. But central banks have been buying assets to increase the money supply and deliberately targeting long-term assets. And by buying long-dated bonds, effectively putting pressure, downwards pressure on long-term interest rates. So the whole of the yield curve has been brought down by central bank actions. In fact, the Japanese actually talk about targeting the yield curve as part of their strategy, but other central banks have certainly been doing that. But the other aspect is that so much money has been pumped into the system over the last 10 years or so that not only have interest rates come down at all maturities, they've come down across all the spreads as well for different credit risks. So the unsecured rates have all come in, and so arguably risk is being very finely priced. You're not paying up as much as you might do if you're a risky borrower. Now, of course, this is again how policy is meant to be working. It's meant to be making it more attractive to borrow and less attractive to save in order to generate investment demand and consumption demand. So this is intentional. It's not a side effect. But that also means when interest rates start to go up, starting from very low levels, you're going to get some very big shocks potentially, and you may not need to tighten rates very much in order to have these effects, as all the credit spreads and term spreads start to widen out on the back of that. So it is quite a complex picture, and we do need to look carefully at the different interest rates. And what happens in the economy is that there are different groups exposed. So, for example, not all house owners are exposed to rising mortgage rates. It's younger people who have only just bought the house with very high loan to mortgage ratios who are quite tight. If you get interest rates going up at the same time as unemployment starts to kick in, then it's particular groups who will lose out at the margin, and that's where some of the risk to the economy comes from.
Yep. Thanks for that explanation. Good. One point I would pick up on though, because you sort of did hint at the secured end and the unsecured end being brought down by lower interest rates, and I go back to this credit card interest rate, and it is quite interesting because credit card borrowing is now, I say, 3% higher than it was 15 years ago, and at a time when the bank rate has gone down from 5.75% down to 0.1%, so you wouldn't quite expect that to be the case. But if you question people about their credit card borrowing, they go, well, interest rates are really low now. They've gone so low, it's 0.1%, isn't it, bank rate? They've gone so low, we're borrowing more money. They don't really have any perception of the interest charge, the APR that they're paying on this borrowed money, because that is actually, so it's almost an expectation things again. They expect interest rates to be low, so they're borrowing more money on their credit cards, even though their credit card rates are actually higher than they were 15 years ago. It's an interesting thought.
They have come down a bit, but it just means they're ridiculously exorbitant rather than even more ridiculously exorbitant. But we all know nobody who's got options should be borrowing on their credit card. It's much, much cheaper to get, say, a bank overdraft or a loan, pay off your credit card that way. But people either can't or they don't, and they end up paying these very high rates for things like payday lending or credit cards. And I assume a lot of that is because they either can't get access, or there's a certain amount of illusion going on as to what the interest rates are they are actually paying. But that's not the right way to borrow.
So very important, you youngsters, make sure you don't borrow on your credit cards. Do in fact negotiate loans at much lower rates and manage them much better than you would otherwise manage your credit card. We're going to stop there because we don't want to bore you for too long, and we will come back with another chat. Next time we will look at the other side of monetary policy and have a little talk about QE, what it is and what it isn't. Thank you for that.